24 hours with JB. Let's talk. We're going to flip through the pages on this one, y'all. Give y'all a little insight to what I've been working on, putting two and two together. Let's get it. Jobless claims are a statistic reported weekly by the U.S. Department of Labor that counts people filing to receive unemployment income insurance benefits, right? Unemployment insurance benefits. There are two categories of jobless claims. Initial, which comprises people for the first time, and continuing, which consists of unemployed people who have already been receiving unemployment benefits. Jobless claims are an important leading indicator of the state of the employment situation and the health of the economy. Jobless claims. Always pay attention to jobless claims, because if they're rising, that means more people are not working. If more people are not working, then what? The unemployment rate is ticking up. And you don't want that unemployment rate ticking up, beloved. Let's keep it going. Out of the 6 U.S. recessions since 1980, 5 were preceded by a yield curve inversion of at least 20 days. When you deal with the yield curve, you're dealing with bonds, right? The 2-year and the 10-year especially. If the 2-year goes over the 10-year, then that's an inverted yield curve. So in other words, if you're getting more money they consider them bond vigilantes. If bond vigilantes are demanding more money through the rates that they're receiving on their bonds, then that's not a good look, because for the 2-year, because really and truly you should receive more. You should receive a much higher interest rate for a 10-year bond than a 2-year bond, right? Reason being, you're lending the treasury money for a longer period of time, for a longer duration. That's what the 10-year. The 2-year is a shorter period of time. So thus the interest rate on the 2-year shouldn't be that high or higher compared to the 10-year, right? And all of this is shown on a chart. On the chart, you see the 10-year and you see the 2-year. Now, bond vigilantes is what they refer to them as, especially in this instance. If bond vigilantes are demanding higher rates for a 2-year than the 10-year, then that 2-year goes over the 10-year, and that thus gives you an inverted yield curve. Does that make sense? I just want to make sure we're on the same page and I'm not losing you all. Let's go. So again, out of the 6 U.S. recessions since 1980, 5 were preceded by a yield curve inversion of at least 20 days. Basically, the yield curve was inverted for at least 20 days, right? The 6th being the 2020 pandemic downturn followed a 6-day inversion, right? As I just told you, that inversion in August 2019. Even if a yield curve were to normalize, right? Normalize would be the yield curve being higher on the 10-year side and lower on the 2-year side. Even if a yield curve were to normalize, it doesn't mean the economy won't stumble. Anytime you hear an economy stumbling, that's never a good thing. Listen up. Take notes even. History has shown that problems begin when prolonged periods of inversion end, right? In other words, when the inversion of the yield curve comes to a halt and it fixes itself, that's where the problems begin. This is what history has stated, historical data. Let's keep going. The 4 most recent recessions in 1990, 2001, 2007, and 2020, i.e. COVID-19, the pandemic, we know what that is, right? Started only after the curve turned positive. That's some good food. Take notes on that, beloved. Okay. Now we're talking about charting, right? Technical analysis, RSI, Relative Strength Index. Let's get into it. The RSI measures the speed and magnitude of a security's recent price changes to evaluate momentum and also overvalued or undervalued conditions in the price of that security. When you speak about momentum, you're speaking about, is the stock more on the bullish side or is it more on the bearish side, right? The RSI gives you a glimpse of this, a synopsis of this, right? It helps you gauge the security better, right? When you're talking about securities, equities, that's stocks usually, although securities and equities differ. Let's keep it going. Let me give y'all something. Let me give y'all some good food. Exponential regression. Exponential regression slopes are expressed as percent. The line slopes up by a certain percent each day rather than a certain dollar amount. This is for my technical analysis traders, right? Exponential regression. Let's keep it going. Coefficient of determination is a standard statistical measurement which tells us how well the actual data fits the regression line. That means how well our regression slope explains the actual prices. Again, this deals with technical analysis, right? You have fundamental analysis or fundamental trade, and then you have technical. Fundamental is more books, more what's going on a day-to-day basis. Technical is when you get on them charts, right? When you see lines and candle and stick patterns and things of the sort, right? This is where you deal with coefficient of determination, write that down, as well as exponential regression. Those two things deal with technical charting. Let's keep it going. When rates go up, bond prices typically fall. As rates fall, however, bond investors may get a boost. Just as rising rates can hurt bond prices, falling rates may help. Depending on the maturity of the bond, someone who already holds a bond before rates declined is likely to benefit from the higher yield available. I don't think y'all heard me, so I'm gonna run that back. Listen, depending on the maturity of the bond, someone who already holds a bond before rates decline is likely to benefit from the higher yield available on their bond and likely sees their bond price rise if rates fall. That said, falling rates, we're talking about interest rates, right? Falling rates will also lead to lower yields on newer bonds. This may provide further incentive for investors to invest in bonds while interest rates and yields remain elevated. I know that was a lot, but that's the bond market for you. Bonds have typically fared better than stocks during periods of extreme volatility. Therefore, an allocation to bonds may serve as the ballast when rates come down. In other words, you want to diversify your portfolio. 60%, 40, right? Some do 60-40 stocks, bonds, or vice versa. But traditionally on Wall Street, that's how it goes. High yield bonds typically pay more than treasuries in order to persuade investors to accept their levels of default risk, right? High yield bonds, aka junk bonds, is what they refer to them as, pay a higher yield because they're more riskier, right? The treasury, 9 out of 10, he's going to pay you back. High yield bonds, aka junk bonds, is sus. So thus they're going to throw you a little extra more in the bag. on the return side. The higher yield is known as the risk premium, and the difference between it and the yields on treasury bonds is called the spread. The higher the return on high yield bonds, the higher